Hello everyone and welcome to this presentation, Advanced Volatility Trading Strategies. My name is David Land, and over the next half hour or so I'll be discussing with you a number of different volatility trading concepts using your charts, but most specifically looking at some of the work done by two authors on the topic, being John Bollinger of Bollinger Band fame, and another author who you're probably a little less likely to have heard of, named Mark Whistler, who has also done some really interesting work on volatility trading. And so I'll walk you through some of the concepts that these guys have discussed, and hopefully give you some pointers as to where you can go for basically using your own volatility based trading tools on your own charts. But before I begin, I just need to give you a moment to have a read of our disclaimer, and I'll just give you a moment to have a read through of that, and we'll get started straight after. Okay, now what I want to basically talk about here first of all is when you look at the components of the Bollinger Bands, the typical default settings are to have a 20 period moving average and then an envelope of volatility bands surrounding it, being at plus and minus 2 standard deviations. Now, I'll discuss with you in a little while what the standard deviations are trying to tell you there, but one of the main not exactly a misinterpretation of the bands and the moving average would say that because the reason why it's not a necessarily a misinterpretation is that what I'm saying is not always the case, but the alternative, the contrary view, is not always the case either, and this is why we need to be a little bit careful about the way in which we interpret Bollinger Bands. Now, a lot of people would suggest, well, if the price is at the long-term moving average, then that's probably pretty representative of fair value, if you like. That it's it's in a happy place essentially. Now, what Mark Whistler would suggest, and he has a number of illustrations to suggest that this is the case, is that prices trading at the long-term moving average are doing so because of a great deal of uncertainty about future price direction. And all you need to do is, I would suggest just jump onto your trading platform and look at the long-term charts of, say, the Aussie 200 index or something similar, and you can see that during times when, particularly pre-GFC, as the bull market was in full swing, the price never went anywhere near the 200-day moving average. So bear that in mind. Now, as Whistler said here, and I'm taking this from his book, Macro to Micro Volatility Trading, he says, over the long haul, data at or near the mean indicates participants are uncertain about current events, unsure about the future, or unclear about what could unfold tomorrow. What we're talking about is a lateral market, likely consolidating or experiencing very choppy trading. Now, what the interesting takeaway from this also is that when we're trading at the mean, we need to be looking as to whether we've come from a trend or whether the market is in something of an oscillation. Now, what he goes on to say here, and I'm sorry to be just reading direct from the slides here, but it's just for emphasis sake. He says, with data consistently away from the mean on a longer term basis, outside of the 1.25 standard deviation on a longer term basis, expectations are aligned and trending is in effect. What's more, with expectations aligned, fear and uncertainty have likely significantly decreased, and thus probability volatility decreases. So this basically reflects what I was saying a moment ago, is that you can view the price being outside of the bands. Now, Whistler, as a difference from Bollinger uses 1.25 standard deviations. Now, what this means, and I'll show you in a little while, it basically incorporates a little bit less, I should say, of the expected price. Meaning you would expect less of the price to spend less time within the bands, but it's really quite neat from looking at it from a trending perspective, and I'll show you some examples of this. Now he typically uses 200 periods for the long-term view and 50 periods for the short-term view. But the fun thing that you'll find about this, what I'm discussing with you here, is that you'll be able to actually jump on to your charts and have a little look at them yourself, and you'll see very readily, I would suggest, exactly what I'm talking about, and what I'll show you in some chart examples in just a little while. So the idea now is not to feel that the mean is representative of value. The mean, the long-term mean, prices trading at the long-term mean, should be viewed as a time to be uncertain, and I think you'll find when you look at trends breaking down, and this can be uptrends breaking downwards or downtrends breaking upwards, what you'll find is that their move back towards the mean is indicative of a pretty significant change in the overall sentiment of the market, moving from consistently aligned opinion, as a trend would be, to unaligned opinion based on a sideways and ranging market. So don't feel that buying at the mean is representative of a good value buying opportunity. The other thing to basically keep in mind with this is the idea that when price is at the 200-day moving average, which is a common one that a lot of technical analysts look at, this doesn't represent a good buying opportunity, but the 200-day moving average is kind of representative of where uncertainty lies. So as you see it cross from one side to the other, it may start to give you some indications as to what's going on. So what we can start to see here now is the 200 period moving average, 200-day moving average that I've got running through the prices here. And I've got Bollinger Bands or volatility bands, if you like. These are just 1.25 standard deviations above and below. And you can start to see on that moving average view here just how often the price bounces back to this level, where we go through periods of trending and back to uncertainty, trending and back to uncertainty. Now, you can see it's at some of these instances here. Some of you may be thinking, well, actually, this would have been excellent buying around these levels, and that may well be the case. Certainly not a universal necessarily, but you can certainly see that this has been the place, I should say, that prices quickly return to as certainty has been eroded. So I think that's really quite neat. It doesn't have to be precise, but you can see it's very close to it, and this is where price returns to again and again and again. So it's certainly a place that's worth keeping in mind. Now, when we look at Bollinger Bands, Bollinger Band is a band, as I already mentioned, plus and minus 2 standard deviations above and below the moving average. Now, the thing with your standard deviations is we start to look at them as determining how much price action we think will likely occur within the bands, and this is where the statistics of it starts to come into play. So the idea that a lot of people look at the markets and say, okay, well, price is outside of the Bollinger Bands. This is a statistical improbability. Therefore, I'm assuming that price will quickly retrace back inside the bands and head back towards the average. And from a broad sort of helicopter view of the of things, you can see that that's a reasonable assumption to make. Upsettingly, it's not necessarily the correct one though, or it's not the one that we should assume is going to be the case. A move outside of the Bollinger Bands doesn't give us a expectation that price is immediately going to revert back within them. Now, what I've got for you here, courtesy of the good folk at Stanford University, is just a distribution curve, or a bell curve as it's otherwise known. Now, this is a normal distribution curve, meaning that half of the data is on either side of the mean. It's evenly distributed around the average here. And at plus and minus 2 standard deviations, we can assume that 95% of price or of observations are going to occur within this envelope here. So this is why people get very, very interested in Bollinger Bands, because they assume that these are the outlying events here, what they call the outliers, or the long tail events, is a term which was popular among statisticians but entered the sort of common parlance after the GFC. You can see the idea that if we're getting out to here, then we assume most of the price activity is going to occur, so price should come back this way. Now, what we find, however, is that in a normally distributed environment that will be the case. However, in a market environment, it's not necessarily the situation. Now, I'm not going to go into this in great depth, but Whistler, in his books, basically uses, he says that the mean is the outlier. And what he means by that, the average being the outlier, is that prices, when they're trending, will actually go nowhere near the mean. The mean is a sign of great uncertainty in the market, and so shouldn't be viewed as a place of high security or something like that. So what we want to do next, and when we get to the examples, this will hopefully make some more sense to you. What you'll see is that the way to start breaking this down is to look at our longer term markets first, and then start to break it down into the short term. And the reason for this is that when we look at volatility based analysis on charts, nothing in it is really visible to the naked eye. It's not like typical support resistance levels or something like that. So what we need to do instead is start to look at it in a slightly more clever fashion. And to find the key points of inflection on the chart, we need to look at things like monthly, weekly, daily. Even if we're trading on the half hour or the hourly chart, you need to know where these points of inflection, these major support resistance levels, are likely to be on the longer term charts, so that we can best take advantage of them on the shorter term. Whether to take advantage or just simply not be tripped up is a very good point, actually. So, using from John Bollinger's book, Bollinger on Bollinger Bands, he says that long term is the time frame in which you do your background analysis. So you're not going to have to do this every day, but it does give you your broad thematic of the market that you're interested in. It is the environment in which you determine your overall outlook and the broad strokes of your investment plan. For investors with long horizons, monetary and fiscal policy figure importantly, as does the flow of funds, valuation data, and the regulatory environment. For investors with a shorter horizon, important factors might be the direction of the 200-day moving average or the slope of the yield curve. So what we're really starting to look at is to look on a regular basis as to where our different time frames are actually headed. And as I say there, it doesn't matter if you're planning to trade on the 30-minute chart or the 5-minute chart, you still need to know where things are in the grander scheme of things, because it's basically, if you think of it like a say poker, for instance, your 30-minute chart might be ace high. Your hourly chart is a pair of twos. Your 4-hourly chart is a pair of kings. Your daily is 2 pair. Your weekly is 3 of a kind, etc., etc. I'm probably carrying the poker euphemism a little bit far there, but the point I'm saying is that each of them is basically outstripped by the one above it. The the monthly trend is more powerful than the daily trend, etc., etc., etc. So know where you are in the grander scheme of things when it comes to this type of price analysis. Um, Now, the other thing to start to think about is that we also need to know what is the direction of the market broadly. And Bollinger mentioned it there with the 200-day moving average and its direction. The actual note is whether the long-term moving average is actually trending higher or lower. The only time that we're really interested in that mean reversion type setup that I mentioned is if the moving average is heading sideways, if the market is actually heading in a horizontal direction. Then we start to get interested in mean reversion. But when it comes to a trending market, we're looking to find opportunities to basically get on board with that trend and basically move in line with the trending direction. So what we can see here in the broad term, you can quite clearly see a trending market. Now, just by looking at the 200-week moving average, I'm only going back to weekly here, but you can see that the price is pretty consistently heading in an upwards direction. You can see that there has been some retracements back to the 200, breaks through it, retracement back, so on and so forth. Now, what we're also interested in are these points that I've marked with the arrows, where the price has broken outside of the plus 1.25 standard deviation band of the 200, and it's retraced back and touched it and bounced off. These bands, this plus 1.25 standard deviation, actually can become a point of support for the price. So it's quite exciting. You can see in the shorter term charts here, this is the 50 with 1.25. You can see that same sort of tendency for it to not always, but certainly offer up a support level for the price. So being aware of these points and where we are in relation to the broader moving average is very, very important to us. You can see I've also just added in my more typical analysis here, a nice little symmetrical triangle. Then as we basically break down into it, we can start to see, okay, well, the longer term trend is up, but notice here how the lines have become parallel. So this is what we would call, this is actually the time when we're starting to get interested in mean reversion. And you can see that as the price has moved up to the band here, it's retraced back to the mean, and then up close to the band and back to the mean. This, if you imagine that distribution curve I showed you before, this is basically the closest you're going to get to it on a chart. This is where it's not quite, it's far from 100%, but it's basically a distribution around the average. So this time, when the price is heading sideways like this is the time when we actually start to get interested in the idea of mean reversion. The rest of the time we're much more interested in following the trend. We start to break down into the 4 hour, and you can see it's the same basic pattern occurring here. We've got essentially you've got what's a kind of a symmetrical triangle forming up here, fairly steep. The breakout of that may give us a direction in the short term, but whilst the trend is trading sideways here, we're expecting price to basically oscillate around the mean. Now, if we go into the 1 hour chart, you're seeing much the same type of operation in effect there. So this is the time when we're interested in mean reversion. You can see at times like this, when the price is trending, price is basically bouncing along on the outside of the price bands there. So knowing where we are in terms of our prevailing direction is very, very important. Here's an example of a better trend, and you can note here that the price is basically hitting the plus 1.25 standard deviation band, or the top side of the containment zone as Mark Whistler calls it, and you can see it basically bouncing along here. So whilst it is the case, this remains basically our expected point of support for the price. You can see it's often quite precise. It's not always as precise as we might hope. It's not like a neat little support and resistance level, but breaks down within this level and then above it at times when we're starting to think much more bullish and optimistic thoughts about price movements. We're not, you notice if I sort of said, okay, well, the price is outside of the bands here, then surely it's going to revert back to the mean. And you notice from here through to here, we don't see any of it. Basically, it doesn't go anywhere near the long-term moving average that we've got here. So this is why we don't assume that price is going to immediately move back towards the mean. We basically assume it's going to, whilst it's trending, we assume it is going to remain outside of the bands, and that's basically the important takeaway there. You can see as we break this down a little bit more, the price action actually becomes a little bit more uncertain. You can see when it goes through this period of sideways action here, it forms up into a triangle and breaks out. And the irritating thing here from the perspective of the daily trader is we think, okay, well, we're getting very little in terms of the support like we were in the weekly prices, but we've established that our broad direction is bullish. So we are still interested basically in moves that occur outside of the bands because that reflects the prevailing trending movement. So moves often outside of the plus 1.25 standard deviation bands are still enough for us to be quite enthusiastic about. And it's interesting in this case actually that the 200 day moving average, you can see, is actually quite a good support line, or it's definitely a point of inflection for price moving gradually higher. Again, it's not typically we wouldn't look at this as a support line, but certainly with the big macro weekly trend looking so strong, this has actually proved to be the basically the prime determinant of direction. Getting down into 4 hours, we're basically going nowhere at this stage here. We're back into a bit of a mean reversion trade. So depending on the time frame we're looking at, we would say, okay, well, whilst we're trading in this sort of 104, 103 range, we're not really expecting a great deal of activity. So a breakout of this trend may see us, and if I just go back a point, we may say, okay, well, that's, sorry, I've skipped onto a previous chart, a separate chart. If you were to skip back onto a higher time frame, which I don't have in this example, you would be able to then to say, okay, well, I am looking at the prevailing direction. If we determine that the daily or the weekly is heading up or down, I'm probably going to jump in line with it. But interestingly enough, in a fairly standard fashion, we'd wait for this triangle to break and then view that as an opportunity, quite possibly to get back on with the prevailing trend. You can see in both of these cases, starting at the 4 and then at the hourly, both of these are back to sort of mean reversion examples. So at this point here, I'd pretty much be expecting price to move back down to 103.50 or in that region there. So these are the points to make from that. Again, here you've gotten price where it's gone from the trending move, bing, 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 all the way down, and then the trend has started to break down. We have returned to the mean here, and price volatility is starting to break right down. You can see these bands are now turning horizontal. So again, mean reversion is expected here. So whilst they're trending, you basically give the trend the benefit of the doubt. When the price levels start to go horizontal, that's when we change our perspective of it entirely, and this is a similar type of example here. But what I'd suggest you do is jump on your charts and place your bands of the 200 with the 1.25 and 2.25 standard deviation, and the bands with a 50 and a 1.25, and start to rifle through, and you can start to get an idea of the way in which the market direction actually occurs. The reason which will hopefully be reasonably plain now is why we don't always assume mean reversion is because the mean isn't staying still. When the mean is at this type of point like this where it's drifting sideways, the mean is largely standing still, so we can expect a degree of mean reversion. When the mean is travelling, we don't expect price to be going near it. It's basically staying away from it. So this is really, I think, quite the helpful point to make. When you see the means travelling sideways, mean reversion can be expected. When the average is travelling in a consistent trending direction, we don't assume mean reversion. And so this can give you a big help as to working on sort of prevailing directions of the market. You can see, just as a really sort of final example of that, the 200 with a 1.25, and you can see price trending very consistently here in terms of the moving average, and price is going nowhere near it. So this means that my bias would certainly be to the bear side, and until price basically makes a concerted breach back inside this level, we're going to be looking for bearish setups only on this time frame. Similar here, you can see price is starting to the band's starting to widen out. It's gone from a long-term sort of sideways movement and only starting to move now. You can see the shorter-term time frame starting to break, but you can see price is now starting to skate down the minus 1.25 standard deviations of the 50-day moving average. So this is now starting to give us very much a bearish bias to things. So this is the type of strategy that you can apply to really help you when you're overlaying it against your other tools. Certainly what I would suggest is, as you're moving through your time frames, mark your 200-day moving averages, your containment zones here, as Whistler calls them, the 1.25 standard deviation marks, and the from the 200 and from the 50. These can be really helpful pointers to know where you may see some price inflection on the shorter time frames that you're trading. Okay, so thank you all very much for watching. Now this is the first in what will be a series of sessions on volatility based trading, so do keep an eye out at them on the blog at cmcmarkets.com.au/blog, where we'll be adding to these for some time now over pretty much fortnightly increments. But again, thank you for watching, and all the best with your trading, and do drop us any comments on the blog. We'll be more than happy to get back to you from there.